how to buy real estate with no money down. Today we're talking about seller financing, but we're talking about the right way to do it. Not what these YouTubers and these podcasts and these overnight gurus tell you to do. We're giving you the real life experience. I've got my wife here, Andrea Stephan, real estate broker, property manager extraordinaire, helps own and operate 258 units with myself. I just find the deal and buy the deal. I just sign on the dotted line. She's the one that runs it all. You've done a lot of seller financing deals recently with clients. We're starting to see this really pick up again, so we wanted to make this episode to give you guys the tools and tactics to be successful and give you the reality of real estate investing. We share our journey as we are at 258 units, working to 1,000 units to help you in your journey no matter what. So let's get right to it. Seller financing / land contract. Man, this has just taken up in popularity recently, and more you're seeing it, and we're getting a lot of out-of-state buyers wanting to come into the Metro Detroit market because watch out, it's on a comeback. What is seller financing? What's a land contract? If I'm just listening to this, I'm like, ooh, no money? Yeah. No money? Buy me some real estate?
Well, that's where you're wrong. You need the money.
So wait, I can't get rich overnight with no money, not doing any work, just being a goofball on the internet?
Well,
you sure?
You want to go into business with someone like that. But so seller financing, you need a down payment. So remember that you need a down payment because again, nobody's going to take you seriously if they're like, hey, I'm going to pay you $5,000 a month for this property, but I'm not going to give you anything to get started.
I'm going to buy your property, but I want you to pay me,
Yeah.
right? Start off with, what is seller financing?
Yep. So seller finance is you are paying the seller instead of getting a loan from the bank or paying for it in cash.
The seller is the bank. The seller is financing you the property. Interchangeably used with land contract. I think land contracts like what the old school guys call it.
Well, it has to do with like title and things like that. So yeah, there are a little bit of variance, but to keep it very simple, you're paying the seller when it's seller finance land contract.
So the difference is instead of going to my local bank or credit union, I'm going to go to the seller. The seller's going to offer me financing.
But one thing to remember on that, just because the seller is approving you and not the bank, the seller can ask for anything. So they do need to approve you. Like, so on my deals, they ask for credit reports.
Really? Sellers ask for that?
Yeah.
I thought so. Okay. The gurus on the internet say no credit, no down payment. You could be a felon and have four domestic assault charges and go get you this piece of real estate. So you've had sellers.
You could. No. Every time I've come across this in the purchase agreement, because again, there's still a purchase agreement and you want one. You do not want to go into this with just signing a piece of paper.
Sign right here, buddy.
Here's
I'm going to take it over. Hey.
Yeah, no, on the purchase agreements, at least that we write and that I've had conversations with, that there are land contract opportunities. They want to see his liquidity. They want to see their PFS.
What's a PFS?
Personal financial statement.
Everything you own minus everything you owe, it's your net worth, right? Yeah, you can't pay your bills with the net worth, but it is a barometer of your financial responsibility.
Right.
Same thing with the credit score. So this is really good insight because see, I thought the whole reason people go seller finance is to avoid all this. So this is really good insight for the audience though, that it's not this just like kind of blank statement thing, right?
Right. I mean, the seller could be more flexible than a bank, right? Because you might only have the 20% and then the rest is in an account where the bank's like, I want to see it more liquid. It is more opportunity, but just think about it. Would you give your property to somebody and expect payments back if their credit score is 500, if they have $2 to their name, and they own a business that doesn't make any money?
When have you seen this used? Because you've done this a lot recently and you're adding massive value for the audience here. So guys, hey, if you're already, I think this is going to be one of our more popular episodes or one of our more beneficial episodes because we're creating this solely for you, right? We don't really do seller financing on our acquisitions. A couple times I've asked, they've laughed at me. When have you seen this used and why would a seller offer it? When we've sold our properties, we've been asked and we've said, no, we want to sell. We want the money because we're going to go do a 1031 exchange.
Right.
So me offering you terms doesn't do anything. So when have you seen it used and when would a seller offer it?
There's two situations that come to mind. One, I'm under contract right now for a deal. The seller had just liquidated a bunch of businesses, other properties. So he didn't want a big taxable event. So he's like, hey, I own the property outright. We'll do seller financing so that I don't have to have a taxable event. Very, very rare because this property is so nice. great location. So
it's a 9-unit apartment building, right?
Yeah. So
that's a
this
beautiful
one is
property.
super, super rare.
Needle in the haystack.
Yeah.
So this seller's offering it because he just had we sell a business as a capital gains event. When you sell rental property, it's a capital gains event. It triggers, it's a taxable event. He just had a huge tax liability. He wants to avoid that. He just wants the cash flow, but he doesn't want to manage it anymore.
He has third party, but that's why he's selling all of his other businesses. He's retiring.
Yes. Got it. Okay. So we've been buying real estate for 4 or 5 years now. You've sold tens and tens of millions of dollars of real estate. How many times have we really seen that offered?
This is the first time I've seen it offered.
Wow. And we own 258 units, right? Everything from single family all the way up to 100 unit property.
Right.
Pretty substantial.
Yeah.
That's where I think people get tripped up. It's a great thing if you can find it, right? It's kind of like Sasquatch. Like, if you can go get a picture of Sasquatch, pretty cool, but good luck finding it, right?
I have one more example too. When it worked, a client I helped purchase another property, he ended up building a really, really good relationship with that seller. Took about a year and a half that he had, again, this was his last property. This is the only commonality I found, and this is only 2 properties. They built a very, very good business relationship. Didn't end up using an agent because, again, it's like the relationship that they built.
Right.
It is seller financing, but again, there was no agent involved. There was just, hey, I have such a good relationship with you at this point. We're kind of business partners at this point. I'm going to take over that property. So that took a year and a half of time and trust that they built with each other. So again, that's a situation it worked, but it wasn't a cold call. I like your building. I'm going to put 5% down. Let me seller finance a deal.
Yeah.
So both of these very, very, very rare situations.
Love that. So what are some of the benefits of it? Because if they're still qualifying me though, what are some of the benefits?
I think, again, you can be flexible so you can sell them on. Again, just because you have a credit score that's in the 600 or whatever the credit score is, and your liquidity might be a little bit lower, you're also not constrained to the bank, your annual review. We get an annual review with the bank every year. So there is more flexibility because you're building that relationship, but you just want to make sure you are paying the seller. So, I mean, the benefit of it is just not that like control from the bank.
This is great information. I thought there was no process. I thought just we agree. That's what it is. They're going to do some due diligence on you, which you said makes perfect sense. Would you just sell your business to someone who you don't do due diligence on? But it's going to be less requirements, less due diligence. Do you need to do an appraisal? Do you need to do an inspection?
No, you don't need to do an appraisal. You don't need to do an inspection. None of that's required. You don't need to do an environmental. Again, unless...
Unlike a multifamily.
Right, multifamily. Unless the seller's requiring that. They can require whatever they want. It's their property.
Got it. So like when Andrew and I go and we buy a property, like our last deal, 42 units, right? We put 25% down. The bank, Southern Michigan Bank and Trust, gave us 75% of that. They are saying, okay, Tony, but this is contingent on a purchase and sale agreement, a satisfactory appraisal, phase 1 environmental survey. We need to have your personal financial statement reviewed. We need to see your global cash flow, your global rent roll. There's more due diligence on the process. Seems like this is a much quicker process. Now, what are the negatives and risk of this? Because nobody talks about the negatives and risk. And you were explaining this to me the other day, and it was really, really good about what can go wrong.
Yeah, I mean, just like anything, there's things that can go wrong in the deal. You're paying the seller. So something that, you have to make sure that's in your purchase agreement. What happens if something happens to the seller? Remember, this is a contract that you owe this seller money every month. So if something happens to the seller and it goes to his heirs and they want the property.
Can that really happen?
Yes, you're under contract with that person. You just want to, again, be aware of these things that could happen. Another thing too is, so we have like a forfeiture clause. So if my client stops paying, because my client's a buyer, stops paying the seller, he can call for the loan.
So it's called calling in the loan, which is common when you purchase through traditional financing. But there's very strict covenants in there that protects you, that says, hey, if you do all this, they can't just call the loan.
Correct.
Right.
With mine, we do say you can't just call for it for any reasons. It has to hit X, Y, and Z. So again, the importance of just don't call somebody and get under contract under seller financing, because you have to have things that protect you along the way.
Which we'll talk about in a little bit here. One of my other questions I had for you was, how do you find motivated sellers? I think you already touched on that. In your experience though, would you say 95% of sellers won't entertain it? 99% of sellers? Like, what's the ratio here? Is it 1 to 100, 1 to 99? I mean,
Is 1 to a million too high?
No, it's being pragmatic
Yeah.
with people.
I think, yeah, 1 in a million, because, and then to remember, this isn't always the case, but then the other hurdle is if they're offering seller finance, their pricing might be a little bit higher because they're offering a lower rate.
Which we'll talk about here. So since you've done a couple of these, how have you seen a seller finance deal structured? What's been the down payment? What's been the terms? What's been the interest rate? What does that look like?
So for this one we're doing right now, it's 20% down. So that is an advantage right now, because a lot of banks are in multifamily wanting 25 to 30. I'd say even 30 is 35.
I would say realistically, because this is a question that comes up all the time, if you're looking to buy multifamily right now, you're looking at 30%, minimum 35%. If you get 25% down, that's very rare. 20% is completely gone. It's not that the bank doesn't want to do it. It's what's called debt service constrained. For every dollar you borrow, you have to have $1.20 in income. And if interest rates are 7% on a value add deal, that just doesn't exist, right? So 20% down in seller finance, that's huge. That's already a huge win, right?
So that kind of goes back to an advantage. You might not need as big of a down payment. So rate is lower than what the rate is right now. So I think it's in the 5s.
Yeah, you're not getting that at a bank or credit union.
The terms are about the same. So this is a 5-year balloon, so he's going to owe the remaining in 5 years.
Well, what's the term though? How long is it?
This one's 30.
So this is a 5-year term, which means he has 5 years to make these payments, but it's amortized over 30 years.
Correct.
That's rare. So typically on a multifamily, a small multifamily, you might get a 5-year term, which just means you have 5 years to make these payments. Then the lump sum, the balloon payment is due in 5 years, or you have to refinance it. On a 9-unit value add deal though, you don't need 5 years to run through it, right? To improve it and be able to refinance it. But amortized over 30 years, it means you're making monthly, is it principal and interest, or is it interest only?
We did principal and interest.
It's just good. Just pay it down. You know what I mean? You're making payments as if you were paying the loan off over 30 years. A lot of banks and credit unions with first-time investors, they'll give you a 5-year term, but they'll amortize it over 20 years, which means your payment is way higher, which means it's not going to cash flow as much, which means you have to bring more money down. That's where the challenge is right now with traditional financing is people want to do these deals and sellers want these prices because it's good real estate and there's not a whole lot available out there. But the down payments are so high because the banks are like, we're only going to give you a 5-year term over a 20-year amortization. So your payments are higher. There has to be cash flow there. I hate to say it, but this is like a home run deal. Okay, so I love this. So what types of properties best fit this structure? Like, is this going to be an A+, beautiful location property? Is this more of like a tertiary property, more of like a, like you said, remote property, or maybe some distress to the property? What types of properties are people looking for to offer on this?
Yeah, I mean, this one, for example, is very, very rare. I think more out in areas that aren't as populated. Any area that's not going to get financed as easily.
Completely agree. And there's not as much demand. You guys got to understand, if we're selling some of our small deals this year, they're in great areas. They've got great rent. The expenses are low. They're managed extremely well. I have no incentive to now offer an incentive on top of that of I'm going to finance you, right? Typically what we've seen, and it's funny, I asked one of our brokers who sold us our 100 unit, our 56 unit, our 42 unit, who's trying to buy a deal over here these days. I've been trying to buy this 200 something unit. The 200 something unit we're looking at, her father built it in 1980 and then she took it over. So this deal's never been for sale. Right? In how many years is that? 45 years, 50 years? I said, would she offer seller financing? And he just chuckled. He said, no, because she wants to pay out her and the investors and the family members and all this. He said, in my experience, he's done this since the 90s, since you and I were in diapers watching Rugrats. Shout out if you know Rugrats. He said he's only seen seller financing a handful of times. More in tertiary markets where there's such little demand, they have to incentivize people to come in and do it. So if you're okay with that, there's nothing wrong with getting started in a tertiary market, but don't you dare look at, let's say, an 8 unit that's on the market, and let's say in Michigan, like Royal Oak, Michigan, listed by a reputable broker. It's a good deal, and say, I'm going to buy it. Let's say it's just listed for $1 million. Hey, I'm going to offer 800 and I want 5% down, seller financing at 4%. Like, they're not even going to answer your calls. You're going to look so uneducated. You're going to look so much like a novice. If they're offering seller financing, it's typically, there's a reason. Very rare is it like, I just sold a bunch of businesses. I've got too much taxable income. I'm going to offer this. It's usually because there's distress or because it's in an area that no one really wants to get into. So they have to make it more incentive.
Or the other one, I kind of touched on it. They want this price that's crazy. There's one out there right now. Love the area. I mean, the price per door, I think it's in like the 200s. I would say it's like an A area, and it's 8 units.
200,000 a door?
Yeah, but she's owned it for a really, really long time. It'll work for seller financing, then it's overpriced. If the property is if somebody has listed it for seller financing, a lot of times it's overpriced.
There's an inverse relationship between price and interest rate. The lower the interest rate is, the lower my debt payment's gonna be, right? Which means then the price of real estate goes up because sellers know you can afford more real estate. And the lower debt is, the more the values go up, right? I should say cap rates and interest rates are inversely correlated, right? So in this example, it's an 8 unit. They're offering what, 5% interest rate or something like that?
She wants like even in the 7s. Again, unrealistic.
Sure.
Right? So here's one offering seller finances. She said she went to Chase Bank and she said it could be 7 to 14%. I just said, okay.
Yeah, sure.
But this is just, again, what you deal with when you're at this level when it's not traditional financing.
Typically what it's going to be is it's a lower interest rate, but you're going to pay more of a price. Because again, why are they going to give you a lower interest rate, but then ask for a lower price? Right? They're going to say, give you a lower debt payment, but I want my price. That's usually what it is. It's like, hey, I want my price, but I'll give you terms. That's a fair trade. That's a win-win negotiation. Every negotiation needs to be a win-win. Should they still use a title company and an attorney for documents? Should I just sign the back of a napkin and like give it a good old handshake agreement? What are you having your clients do to be protected in these seller finance deals?
Yeah, 100% title. That's non-negotiable. So you need a good title company to make sure that all the documents are being taken care of the right way. Everything is filed appropriately. So title is huge. Attorney, I mean, it doesn't hurt, but definitely a real estate professional. You definitely need an agent or a broker who knows what they're doing to protect you in future
100%.
Situations. Because again, this is a contract. Sure, you can sign something that just says, I owe you $5,000 a month and that's it. But then again, you always have to think of everything that could go wrong and make sure you're protected by that.
It's a business agreement. And the thing that's nice about going to the bank or the credit union, it's a reputable agreement, right? You know, they have lawyers, you have lawyers. It's very standard. The annual reviews are very minimal. A lot of people get stressed about that. I mean, I have some credit unions I don't really hear from. Other ones are like, send me a rent roll, send me your net worth, your personal financial statement. If you're smart and you're doing the right things, your net worth should be going up every year. Like, you know, ours does. It's not that scary of a thing. I love what you're saying. You have to hedge for the downside with it because no matter what, it is still a business arrangement. What would you say is some common misinformation about seller financing? I would say the big thing is it's prevalent. Number one, you're seeing a lot of it, which just isn't the case. Number two is you're going to be able to get 3%. So right now we have a money market account with one of our credit unions. We get 4.5%. Why am I going to sell you a deal with more risk than putting in a money market? So if you're already trying to get below like 4.5 or 5%, it's like just not relevant. Also would say that just like how easy it is to find these deals. They're not out there. And if they're out there for a reason. And I think where people get really stuck is they say, I will not buy a deal until I find this, which maybe you have the time to be able to do that. But how many months, let alone years, are you going to waste not doing a deal?
Yeah, I think that the biggest thing was what the broker that we work with told us about how rare it was for him. I don't see it on the market. Very, very rare do I see it on the market. And then when you ask about it, they almost laugh at you. That's all. It's kind of like you said, you want to just get started. So don't wait out for that seller financing deal. And if you do have one that comes across your table, I mean,
jump on it.
Yeah. Absolutely.
So great information. As we're wrapping up here, what type of investor is seller financing right for? Is there like a subset category for that? Is it just like, hey, whoever wants to do it?
I think it's for somebody that's also too, I think has a little bit of business experience and or somebody that has real estate experience, because again, at the end of the day, it's a business agreement with another party. So if you're just not familiar with that, like I said, the bank's very cut and dry. It is. It's like you owe these payments. If not, they're going to take the house, right? If you don't pay the seller on these property, I mean, you're talking lawsuits and whatever they want to do to get that property back and your payments. I just don't think it's for anybody to just take lightly at all. I think you just have to have some sort of business experience would be very helpful.
It's kind of like polarizing against what's out there is like, hey, you do this when you have no experience, is how you get into it. You don't know what you don't know. What you don't know the most is what will end up costing you the most. So that is our episode on seller financing. And the thing I would tell you guys as we're kind of wrapping up here with seller financing, the terms matter more than the price. If you can get great terms on a property and be able to tie that property up, control that property, end up paying a little bit more, it's definitely advantageous. Andrew and I would do a seller financing deal. Just on the deals we've come across, we've never seen anyone offer it, but it is a great alternative for you out there as a new real estate investor. So what did you think of today's episode? We would love to hear hear from you. What are your thoughts on seller finance? Do you agree with what we're saying? Did we miss something? Drop a meaningful comment in the comment section below. Be sure to hit the thumbs up. Be sure to subscribe to the channel if you enjoy this content. Andrea was sharing here. She's done these deals for clients, but she's protected them, hedged their downsides, and set them up in a position to be successful. If you want to learn more about working with the Stephan Group Real Estate Brokerage to get into a seller finance deal or a rental property, fill out the link below. If you're looking for one-on-one coaching and mentorship and support, fill out the link below. Grab all the free resources in the description here. You got my book, my masterclass, our due diligence checklist, all those free resources to help you in your journey. Until next time, we'll talk soon. Thanks.